how overvalued are stocks currently? Well, again, Irrational Exuberance, 1996, famous speech by Alan Greenspan. Well, the market ripped double-digit returns for 3 more consecutive years, so I'm not saying it has to stop here, but if you're walking into retirement, are you willing to bet your whole portfolio with that much risk? Make sure you understand the risk you're taking.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, we do a lot of fun things around here, but one of the most fun is periodically we'll hold a reception for new clients, recently signed up clients. It's a wine tasting. We put out a charcuterie spread. We make sure that people are aware of the full array of services available to them. As clients at Retire Smart, we give them a tour. You preside over a trivia contest with fabulous prizes. It's a blast, and we just had another one recently.
Yeah, they're a lot of fun. And what I think was really special about this one is we had a lot of the clients that have onboarded at Lincoln here so far this year that came up and enjoyed it. And it's a great way for clients to invite potential referrals or friends they want to introduce to the firm. So it's just a fun night. I think we had about 40 people in total with employees here, and we do these about every 3 months, exactly giving our newer clients an opportunity to kind of come on board. And for our older clients, I'm sorry, I know, like, hey, why did I get invited to this? Yeah. It's just a way to introduce them. If you remember older clients, we used to do big Christmas parties, but it's just, we can't do it.
We got too big.
We're just too big to do that. Yeah. But we do a lot of client events, and of course we had the memorial event not that far back. So don't worry, we still do plenty of events for our current clients as well. This is just something we instituted about 1.5 years ago, every quarter, doing a kind of a new client mixer, if you will. So it's been well received, and it's a lot of fun. And my wife put a lot of hard work into that spread and board, and it got some pretty good reviews.
In sports, they say the great ones play hurt. Your wife is still recovering from surgery. She's in here yesterday setting up the charcuterie board and making sure we string up some lights. We turn our classroom, we have over 100 vents, and classes and workshops, but we put up a few lights and some cocktail tables, and it's a lot of fun.
Well, I thought it was interesting yesterday. She was in the kitchen working most of the day, but she hasn't been around all year. This is the first day during business hours. On the weekend, she comes in with me a lot, but this, because of some medical-related issues, she was not able to be in the office for most of this year. And so I was counting up yesterday. I think it's 14 employees she has never met. And I'm thinking, wow. Yeah. And so she's like, who are you? Who are you? Yeah. Who are you?
Yeah.
Anyway, that was just showing you the growth that we've received. And of course, it's very exciting. We can announce today that we are officially Inc. 5000 for our 4th consecutive year. And from the folks at Inc. 5000, let us know it's about only 350 companies have ever had the honor of winning that award for consecutive years. Well, that's pretty special.
Here's the thing. Inc. 5000 measures the 5,000 fastest growing businesses in America every year. So to have a great year, okay, you qualify for it. But then to get on there a second year, well, you have to improve dramatically even on your great year, because now your baseline has moved up. A third year is I don't know how many companies have made it 4 years in a row.
Yeah,
but we are.
A couple hundred. And so it's a huge honor. We're truly blessed. But there's growing pains along the way. I recently had breakfast with a wonderful client who was telling me a couple of things where, hey, you got to improve this, which, by the way, we love getting real, true, candid feedback. And that is sometimes the problem when a business scales or grows is you run into some growing pains. And so but we've been so blessed. And of course, the mission is to help as many people as we can. So we're not going to stop. We're going to continue to push. But I tell our current clients humbly, we appreciate the candid feedback, and we'll continue to improve along the way.
Quick programming note, those Teammates events that we were going to have August 8th and August 15th, we're going to push those back. There were some scheduling conflicts, but keep listening. It's looking like October now. We'll give you the details as they become available. All right, David, into the news we go. And here is the Wall Street Journal headline. Trump shakes up Wall Street with orders on 401ks and debanking. What is going on here, especially with the debanking?
All right, well, let's cover the debanking first. This has been going on for a while. The larger banks, and this was led from previous administrations, were a little difficult to get an account open for charitable organizations that leaned to the conservative side of the aisle. And I personally know this because I sat on a board of a charity, and we went to one of the 4 largest banks. I'm not going to shame them by name. Trump does shame some banks by name, so we could probably read those because they're actually printed in the article. But I'm not going to personally shame. But literally 9 months of back and forth to get an account open. And the reason we had to go to one of these large banks is because we were going to receive donations in different cities, right? And so there has to be realistic regulations on these banks of you should be open to everybody, right? Like we just talked about, you can't discriminate. We have all kinds of anti-discrimination laws in this country. Look, if a customer wants to open a checking account, let them open a checking account. But the Trump got debanked, and that's what this article talks about, with some of his organizations, because after he came down the escalator going way back 10 years ago or so, hey, the powers that be did not want to make life easy. And so they did this, and, lawsuits may come about it. We'll see what's happening. So that's the debanking part. And that's just been realistic. That's been a lot of conservative organizations, churches, organizations have found struggles finding a particular bank. Now, there's some good news. There's banks that are going after that marketplace, and that's really going to be their focus. So flip to the other side of the article, and Trump shakes up Wall Street with an executive order. And this is, I think it's a good thing, but I think you should take it with caution. What he's doing is he's trying to allow access to the investments that only our accredited or qualified investors qualify to invest in. Private equity, private credit, additional investments that are not a ticker you can buy, on an app. In other words, so you got to understand is publicly traded companies, when I started, Chip, well over a quarter century ago, there was over 9,800 companies listed on the three major New York or American Stock Exchange, the American Stock Exchange, the New York Stock Exchange, and the NASDAQ. Almost 10,000 publicly traded companies. Today, that number is less than 5,000 listed on all those companies, right? There's less public companies because the way the marketplace. So there are still these companies out here you want to invest in, but they're private, and the average citizen does not get access, and they have better returns over time. The downside is they're not publicly traded, so they don't have to disclose as much information, every quarter, et cetera. So there's some risk involved there, which is why you had to be an accredited investor to qualify to invest in them. So this is going to break down the barriers. Tony Robbins has been championing this move, just so you know, because this is how the average person can really acquire wealth. You can get higher returning assets, but you need to understand the negatives or the cons. Less liquid assets. You have to be in it for the long term. If you're investing, and I invest in some of this stuff. If you're investing in these type of investments, you need to have a 10-year horizon. You don't expect to get a dime back out of that investment for a decade or longer. But this is how true wealth is created in this country. We can all benefit, but we need to make sure these 401ks do their due diligence, and your provider, if you're an employer at work and they're going to open this up, they need to make sure they're giving proper education on this, because I would hate for someone to get into dire straits and have to take a 401k loan. We've talked about on the show many times. Well, they're not going to loan against those assets.
It's not a place you want to be.
Yeah, that's not an asset you're going to be able to get a loan. So it'll lower the amount you could borrow. You're not going to be able to have hardship withdrawals. And again, I hope people don't have to take this anyway, but just tread with caution. But the great news is this is how true wealth is created. So this is going to get more Americans the opportunity to invest like the wealthy really do.
So let me see if I understand this. So Joe Citizen, day trading at his kitchen table, used to not have access to this area of the market. Now he does.
Correct. In other words, you have to be an accredited investor. Like we have all these offerings.
Beware,
yes,
because
yeah,
there aren't as many guardrails.
There we go. I haven't heard that one in a while, right?
In this arena, there aren't as many guardrails. So
correct.
You're taking on more risk.
But you potentially are, and history shows, you will likely get more return, but if your time horizon is aligned. And again, Charlie Munger talks about, right, the power of compounding interest. The only thing you can screw that up is interrupting
Just get out of the way and let it happen.
These are the type of, and just, this is the Buffett model, right? So the Buffett model, right? How does Berkshire Hathaway invest? About a third of their assets are in publicly traded companies, just like we talk about inside your 401k. A third are in private companies, just like this is talking about. This is how they invest. And then a third of their dollars are typically in very liquid investments, cash, treasuries, et cetera. Right now they have like 32% in cash or cash-like instruments. But anyway, so this is how the wealthy actually invest. And in fact, households that have a net worth north of $10 million have over 53% of their assets on average in these type of assets, Chip. So it's a good thing, but again, tread with caution. If these things are not going to be in your 401k tomorrow, but within the next 2 to 3 years, you're going to start seeing these things roll out pretty regularly.
David, you sent the team a chart showing office construction trending downward and data center construction trending upward. What does that tell you?
Well, that's a little bit of a crisscross, and that's just telling you where where are the jobs going to be in America, right? So obviously COVID changed the landscape on offices. We talked about that and how much in trouble banks are on the loans, and we've the keys being mailed in for these big organizations, et cetera. But the difference here is new construction is not rolling back. People are back at the office, but we're not building new offices. So people are retrofitting offices. Some offices right here, the old Merkel buildings downtown, the two copper, they're being turned into condos or apartments, right? We're seeing this change all over America. But what construction is flying off the shelves is data center construction. And of course, right here in the Midwest, we see this across the river, north of town, south of town, data centers and these big data storage facilities are being built at an alarming rate. So will those constructions lead to permanent jobs? That's the problem, is these data centers only employ a couple hundred people, not thousands of people like a big center city. Like we're building, obviously Mutual of Omaha is building a tax incentivized high-rise. Will be the tallest building in Omaha. And of course, Mutual Home is a landmark company here. So we're proud to have them as our center city building. But will they fill the building, right? Will they actually use all those office space? Will it be utilized? The point being is the job market is changing drastically. And if you've got a kid out there, we were having this discussion at the wine tasting this week with someone, hey, my kid's a junior in high school. What should he be looking? Trades. Look at the trades. I mean, you want to get out and make money quickly? A journeyman electrician right here in Omaha that's got 5 years experience as a journeyman is averaging over $165,000 a year, Chip. That's a pretty darn good living that you can learn a skill. You don't have to go to college and spend a ton of money learning things, right? So we need 500,000 electricians today in America. We're short 140,000 pipe fitters. We're short 250,000 plumbers, right? So trades will not be replaced by AI in these data centers, at least not in the next decade or so.
Up next at Retire Smart, we have a division called Tax Smart that is putting on a workshop for entrepreneurs. Here from Tax Smart to tell us about it is CPA Evan Marshall. He joins us next on Retire Smart with David Brooks.
Once again in the studio, we have our chief tax planning strategist, CPA extraordinaire, Evan Marshall. Evan, how you doing?
Doing great.
So you've been doing some traveling. You were most recently spending some time in Peoria, Illinois. So how was that?
It was okay. Very happy to be back in Omaha and being able to serve our clients again. But yeah, great opportunity to see some new places. Yeah, maybe not as exciting as Omaha.
Now, do you have the next destination lineup? And for those of you listening, so Evan right now is on kind of a 2-year trek where him and his wife are kind of circumventing the entire map here of the U.S. and she does some traveling work in the medical field, and we've allowed him to do this for a period of time. So we hear of his adventures. He was out in Bakersfield, California prior, right? So
correct.
Where's the next landing zone?
Yeah, the next one we just found out we're going to be in New Jersey. So we're going to be on the boardwalk, at the shirt shop, doing the full Jersey Shore tour.
Very nice. Well, for our folks that live out this way that are from Jersey, we'll just say, hey, what exit? Because that's how you know where you are in Jersey.
Right.
What exit on the turnpike are you obligated to get off at? So I know Jersey pretty well. My dad lives not too far from the Delaware. It's called the Delaware Water Gap.
Yep.
But I'll give you some great places to go view. It is some really pretty country out there. There's a lot of places you can get to by a short car trip. But all right, so speaking of car trips, sometimes you get hungry. You pull into the drive-thru and, you order things like, a burger and
the French fries.
French fries, absolutely. Now, I was watching a couple weeks ago one of my favorite movies, Forrest Gump. It was just, running on like TBS or something. And there's a scene where his buddy Bubba goes through all the different kinds of shrimp. I want you to tell me, like in tax planning, especially for business owners, it's like ordering French fries. There's so many different kinds, right? And we have a mutual client that we were just joking with about French fries. So I guaranteed him we would make you talk about French fries on the air. So when it comes to tax planning, it's like there's different varieties, right? So how many different varieties do you think there are of French fries?
It's the opportunities are endless, and especially if you go to like different fast food places, like no two fries are the same. We'll see how long we can stretch this
so there's
analogy
shoestrings,
for.
steak fries, crinkle cut fries, coated fries, spicy fries, and then they can add garlic aiolis, and I mean it can get really plenty. But that is literally what you do for high income earning folks and entrepreneurs, specifically business owners. There are so many different angles with which you can show them. You're not doing tax loopholes. You're just showing there are incentives in the tax code and the new big beautiful bill, as it's called, the BBB, layered in a few more that
Yeah.
people need to be taking advantage of. And this literally could change the bottom line of a company by hundreds of thousands of dollars, right?
Yeah, and it's just, the biggest thing is just educating our clients on these new incentives. Like July 4th, like you identified, the One Big Beautiful Bill Act got signed. A lot of new incentives included in the code, especially for those business owners, incentivizing additional business development and just kind of understanding, what is the government currently incentivizing for our business owners, because that's dramatically changed since the last tax change that we had.
Yeah, and so this tax bill made permanent the current tax rates for our personal tax returns. However, corporate tax returns were made permanent the last go round in 2017. And I continued to talk to business owners and find out they're operating in the wrong entity. In other words, most people just set up some pass-through entity because that's what they were told to do. But we find for a lot of entrepreneurs, that's the wrong decision, right?
Yeah. And, that initial LLC setup, or maybe the S corporation, or maybe just did a partnership, and they're just letting it ride, it's at least good to maybe get additional opinion, and then maybe you're either in the wrong entity structure, or it might be good to add an additional entity. Those are just kind of the things that we talk about with our entrepreneurs, and making sure that they understand, all the intricacies of that entity choice.
Yeah, so if an entrepreneur's out there making a couple $100,000 a year or more and starting to earn good income, he's going to jump into today what is typically going to be, say, 22 and then 24 and then eventually 33% tax bracket, and then it goes on to 35 and 37. When corporate tax structure, if done properly, a lot of people are surprised to know, you mean I can knock this down to 21? Yeah, it's potential, right? So, but again, to make sure, sometimes it's just putting a partnership entity alongside, right? Operating under more than one entity. You know how many I operate under, right? And that's because I'm just playing the game by the rules they lay out. I don't have to cheat my taxes to lower my tax bill, but I have to be proactive in my planning. You've been personally involved in my planning for a number of years now. So I just think it speaks to the entrepreneur. So let's talk about the class that you and I are both going to be teaching along with Mike Schudel coming up. And this is we call it proactive tax and exit planning. You do not have to be thinking about exiting your business to attend this class. If you are running a small business, and small business definition by America Chamber of Commerce is 500 employees or less. So we're talking about rather large businesses in reality for a lot of folks. You have incentives in this current tax legislative package that you need to be taking advantage of. And we're going to go through some of those examples at this class. When is this class coming up?
It's Friday, August 22nd at 9 a.m. at the Midwest Learning Center.
And we'll get you in and out in under an hour. I think we'll have some breakfast of some kind, donuts or something. I'm not sure what. I know we'll have the world's best coffee because I demand that. But
always.
We'll have a little snack there for you. But we get you in and out in an hour so you can get on with your day. But you're going to learn about entity structures. You're going to learn about liquidity provisions within your company, and then how you can potentially lower your current tax liability, even if you want to keep your company for the next 30 years like I do. Fantastic class. And if you know an entrepreneur and you're listening to this, you might want to let them know. But we do have to have people register. We will have very limited capacity. You can go to retiresmartnow.com and click on the events page to register, or you can call the office to get registered. All right, Evan, let's switch gears for a moment here and talk about a couple of provisions in the big, beautiful bill that are going to affect our retiree clients, which is a lot, and we have a lot of listeners to this show that it's going to affect, because while we didn't technically get no tax on Social Security, we did get an opportunity to reduce the tax on Social Security and give a large share, by some estimates up to 90% of Social Security recipients could actually be receiving this tax-free, and that's through the senior deduction, right? This additional $6,000 or $12,000 for a married couple. So a married couple over 65 has about a $46,000 standard deduction. Basically, that's huge, but it's only here for a limited time.
Correct. And the interesting part about that is it's actually effective in 2025. So that's actually impacting the planning that we're doing for our clients. We had the understanding of the Tax Cut and Jobs Act tax rates being through 2025. 2026 was a bit of a mystery. It gives us a lot more clarity, and it actually gives us more incentives to take advantage of in 2025 to kind of change the planning for this year to take advantage of those new incentives for this year specifically.
Yeah, and for those that happen to be charitably inclined anyway, we've sometimes talked about a donor advised fund is one of the strategies we help clients use. In other words, you can give future years giving today, control an investment account, and then give it to the church or charity you want to in future years. That becomes even more pressing this year, because though Next year, if you were doing large Roth conversions or had higher income, you're not going to be able to deduct as much going forward, right? So 2025 is a very good year to set up advanced charitable giving as well, as far as the Roth conversions or charitable planning for your estate planning, et cetera. Talk a little bit about that.
Yeah. So, and there's some changes in the charitable giving structure. So, with the One Big Beautiful Bill, you can actually now deduct some charity, even if you don't necessarily itemize. So now there's some new incentives to still do some charitable giving, which we'll discuss with our clients as part of their planning structure. But those certain incentives are not maybe so keenly advised for donor advised funds, meaning that 2025 would be a good year to take advantage of that tax incentive. If you do have that charitable inclination, just taking advantage of that potential strategy that we discuss.
All right. So if you think you're paying too much taxes, you might want to talk to this gentleman. So I want you to talk we got about 30 seconds left in the segment. Emma, just explain what a SEPA is to our audience, because you and I both have attained these certifications. I had mine previous. You got it earlier, I think earlier this year, right?
At the end of 2024.
Oh, you got it at the end of last year, right?
Yep.
And then Mike Schudel got it earlier this year. That's great. I knew one of you got it this year. But so all three of us that will be teaching at this class coming up for entrepreneurs have earned what's called the SEPA, CEPA certification. Can you talk a little about what that's like?
Yeah.
Or what that is?
Yeah. It's a Certified Exit Planning Advisor. So I look at it primarily from the tax realm as a CPA, but David looks at it through the entrepreneur lens. Mike looks at it through the financial advisor lens. And what the certification does, we just are educated on the different exit opportunities from a business, kind of strategizing, maximizing the potential value of the business, the options of how you could exit your business, and kind of being that strategic coach through that whole process, just being that advisor to help unlock the true value of your business.
And I think one of the things that you can do for clients too is, we should just put it out there, is if they've never had their business valued, you can get your business valued, and it's not as expensive as you might think to get a formal valuation done. So you at least have an understanding, what is my business worth today? And then through the proactive planning, in 3 years, what could we increase the value to if you get all your numbers aligned to industry standards, et cetera. But anyway, a lot of great stuff. So this class, again, is going to be Friday, August 22nd at 9 a.m., but you must register. Evan, thank you so much for stopping by.
Thanks, David.
All right, go enjoy some French fries, my friend.
Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. Now, work with me here, David. We are going to end up at finance here, but it's a question about high school grading systems.
Okay.
This isn't, well, here we go. This isn't directly about finance, but it could affect financial literacy. I saw that California has a grading system in which 84 and up is an A, and the rest of the scale is similarly watered down until you get to 24 to 44 for a D. Your grade has to be below 24% to get an F. No wonder we have kids graduating from high school unable to read or manage a bank account. Doesn't this concern you as a professional trying to get people to engage in financial literacy?
This greatly concerns me. Yeah, when I went to high school, you had to have a 95 to an A, 100 to get an A.
Oh,
so the
really?
top 5%.
See, I went to high school here in Omaha, and it was 93 to 100. We were on that more 7-point range.
And when I went to school, if you're using the old 4.0 grading system, right, an A would give you a 4.0, right, a 4, a B was a 3, et cetera.
Yeah.
75 and below was a failure when I was in high school.
75?
Yeah, 75 and below failed when I was in high school. 70
was the ceiling around here when I was in high school.
And so that scares me that we are slowly dumbing it down. Now here, Gretna school system, one of the major school systems that ranks pretty well, just dropped to what you're talking about, the kind of an 8-point system,
93
to a 10-point system. Yeah. Now Gretna, it's 90 to 100 is an A, 80 to 90 is a B.
Yeah.
So I believe that this is terrible. I think this is absolutely ridiculous that we're not holding our kids to a higher standard. And this is where this is why we need so many HB1 visas, because these companies that are growing leaps and bounds and building data centers and need tech people and STEM research, and we met researchers. We need people that get engineering, mathematics. If we keep dumbing this down, we're not going to have a population that can handle the jobs we're going to need, because the jobs for tomorrow are going to be very different. There's going to be careers that we'll talk about 5 years from now that aren't even invented today, right? And I try to explain that to clients all the time. We have new careers. I mean, computer science is interesting enough because coding is now being written by AI. The unemployment rate is twice the national average when you graduate college today. With just 10 years ago, people go for computer science. Not a great job. They have almost an 8% unemployment rate graduating college from good colleges right now. So
you were just talking about the trades in the last segment.
yeah,
Look
so
to the trades.
This is scary to me. And of course, where we went to high school in Northern Virginia, we went to high school. We were blessed. We actually had the county's vocational high school right in our parking lot. It was adjacent, built brand new at the same time. My sister was the first graduating class of our high school. It was called Cortland High School in Fredericksburg, Virginia. And right next to it was the Spotsylvania Vocational High School. And many of my friends, after your 10th grade year, you declared vocational or college prep. So you could stay on the college prep course where you took AP classes, et cetera, and they're preparing you to go to the next step, or you could take a vocational and you would learn. So you'd only go to 3 core classes in the high school. You walk across the parking lot and start to learn how to be an ASA certified mechanic, a journeyman electrician, a pipe fitter, a welder. So you walked out with great skills. One of my best friends, a gentleman named Chris, I won't give his last name out because I don't want to give it away, but he did auto body and mechanical stuff in the vocational thing. Ended up owning 7 transmission shops in Northern Virginia and retired about 3 years ago. Now lives in Florida, near where I used to live. Multi-millionaire. Never went past vocational high school, but he learned skills and became an entrepreneur and learned how to develop and became a multi-millionaire because that was his aptitude, and there was a training available. We need stuff like that left and right. Sorry, going off on a tangent here, back to the trades.
Well, but that giant building at 30th and Cumming initially was Technical High School, Omaha Technical High School, and it was not a second-rate option.
Now we technically call it a HR suck of administrative people that are all earning a ton of salaries.
I don't want to go off on that rant, but no, Technical High School, there's a proud legacy to that school. So, some folks, my vintage and older, some are out there singing Tech High Will Shine Tonight. That was the fight song for the school. But anyway, there's been talk that maybe it should go back to its original purpose.
I'd vote for
be
that.
A vocational school. All right. On to the next question, David. Insurance. My family is covered by my wife's health insurance plan through her employer. I've had friends tell me we should get out of the regular insurance system and sign up with a faith-based group in which members share expenses. Seems risky. What do you think? You have some experience with this, don't you?
Well, I can tell you I've personally been on a religious sharing insurance plan personally for over 15 years. And it works fantastic for me. And so we provide benefits for the employees here. I do not use those benefits. I've never had because I've been on a faith-based sharing program. There are multiple versions of this. And, if the questioner does want to send information, I'll give you who I use personally. I'd be happy to share that information with you. But yeah, just to understand is the advantage is you strip out all the nonsense that you don't necessarily need to pay for, and you give a monthly share. And I will tell you, I'm a 57-year-old male, and my share is about $230 a month. So I share to the system. That's all I have to pay, and I have full coverage. Now, I have an out-of-pocket number that's about $10,000 a year, so the first $10,000 that I would have to spend medically, I cover that. But after that, 100% is covered. My kids have had surgery. My wife has had 2 major surgeries on these, and all expenses have been paid. So
you've never had to wrangle about, we don't cover that.
Everything has been covered that I've ever had to deal with, and I would tell you. So I'm a huge advocate for it. However, you have to sign a statement of faith, depending on the religious organization that you're signing up with.
I've seen different
and
denominations
you're sharing, and then they
offer
even have an opportunity for you can give love offerings to other people that may have incurred additional expenses outside the coverage. And the other caveat is you need to understand is most of these will not cover prescription drugs. So you need to understand if you take a lot of prescription drugs, that should certainly weigh into your factor. We use like Good RX, these discount programs, because we do have a few prescriptions monthly in our household. But anyway, I'm a huge advocate, and it can save an entrepreneur, by the way, Chip. Those entrepreneurs we were talking about with Evan, this can save them $20,000, $30,000. It literally saved me over $30,000 a year.
You don't know what you don't know, as you often say. Yeah.
Yep.
David, final question this week is about one of your favorite topics, Roth accounts. I wish I had run across you 10 years ago. I'm retired and have a couple $1 million in tax-deferred IRAs. I wish I had been putting that money into Roth accounts when I was working because I'm going to get killed on taxes when I withdraw the funds. But now I'm stuck with that tax hit to come, right? Not necessarily so.
Well, you're going to have to pay some taxes, certainly, and I don't know how old you are. That's not information wasn't provided, but I will tell you, for larger RIAs, we have additional strategies where we can help you not only. So here's the worst case scenario, Chip. If you're in the same tax bracket, if you move money from the IRA, the traditional side, to the Roth, you pay the same tax that you'll pay whenever, right? So why not get it out of the way now before your account continues to grow to a bigger amount? Buy out the silent partner, the IRS, at an earlier stage if the tax rates are the same. So these people that argue, well, I don't want to pay the tax man now. Well, if your account's a couple million now and you don't touch it, and let's say this person is 60 years old and they don't have to take an RMD until they're 75 under current law, that's another 15 years of growth. Assuming this account easily doubles in that time. Now, instead of being 2 or 3 million, maybe it's 4 to 6 million. That first RMD is going to be over $250,000 of taxable income, and it won't be at the current tax rates. It will be at a higher
that's
tax
probably
because of how
what this questioner is looking at. You have often said, pay tax on the seed, not the harvest.
Absolutely. On top of that, when we have larger IRAs, Evan, who was just on the show here, we have additional strategies we can layer in to show you how to chip away and discount some of the taxes you would pay for these what we call super large IRAs. So if you have an IRA larger than $3 million, you're going to want to get on the phone with Evan because you certainly don't know what you don't know on how to reduce the tax liability on those conversions.
Well, might this person be a candidate for a Roth conversion?
Absolutely. And they should come in for the report card, and one of our advisors can kind of show them the way.
Up next, we've been sharing good economic and financial news on Omaha and Nebraska several weeks in a row. Is the string broken? There's major concern in the agricultural sector about the impact of tariffs. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I do want to get to these stories about the ag sector in Nebraska, but first let's do a rapid fire of some more items you were sharing with the team about various indicators. The first one is about AI sales, and they're struggling in many places.
Yeah, so the reason I sent this around real quick and sent a chart out, it was a company called C3 AI. They're smaller relative to the larger landscape of AI companies, smaller company, but they've got some significant value, publicly traded. They reported their earnings this week and actually beat their earnings, but the CEO talked about the sales were not keeping up with what they thought they would be for the implementation of their services, and the stock got whacked by over 30% in a day. And so the reason I bring this up is the cautionary tale of I've been doing this a long time. I was in this professionally when we went through the .com debacle, if you will, and that was almost really more of a telecommunications debacle. It was all the communications companies, the .com companies that went and got their valuations cut sometimes by 30% in a single day. So if you have been riding this wave, that kudos to you. You've made some great money, but just make sure you're taking caution and understand the amount of risk that you may have currently in your portfolio, because single day cuts of 30% in a stock, a prominent stock in the leading sector, should be a shot across the bow, a little warning sign of, okay, maybe we don't have the productivity coming yet from all these data centers, et cetera, that are being built, et cetera. We're spending 1/3 of GDP. I talked about last week, Chip, 1/3 of GDP year to date has just been what we call CapEx, capital expenditures, to build the infrastructure that will one day turn into productivity, but it is not yet there. And when will the productivity come to fruition? I don't know. In the .com era, we spent all the money on upgrading websites and everything going digital and going to web-based consumer stuff. We got the productivity on average in 2006. So it took 7 years to realize the productivity gains from the newer technologies. I don't think AI will take that long, but it certainly might take 2 years.
But we're still in that transition phase.
Yes, and so the risk there is if we don't get the numbers that we're paying these lofty prices for on the stock market, then maybe we have to revalue the prices of these things, and that could be painful in your current portfolio if you're taking too much risk.
Next topic, corporate bond spreads. You sent the team a chart showing they're at historically low levels. What is a corporate bond spread, and what does this mean?
Okay, so we pay attention to the spread, what we're paying for different types of bonds. So the safest bond is going to be issued by the U.S. government, right? Because if the government fails, we've got bigger problems, right? So U.S. treasuries are the safest. So you get the lowest yield, right? Because it's the safest investment. So then typically we see about 150 to 200 basis point, 1.5% to 2% more interest. So if the 10-year right now is paying 4%, for instance, Chip, then if you're going to buy a corporate bond, you would expect to get around 6%. In other words, you're taking a little risk now. It's a private company versus the U.S. government, so you get paid a little bit more for your investment buying the bond. And then high yield will be another 250 basis points higher than that. Well, we've seen the spreads collapse. So right now, corporate bonds and U.S. treasuries are basically paying roughly the same, a very thin spread. When that occurs historically, and that's what the chart that we're showing for the YouTube viewers, that is usually a bad sign. In other words, no one is willing to take on the risk to buy corporate debt and the yields are just fading there, or the government is overspending and you're not getting it's not as safe. So if it's no safer than the corporate bond, why are you buying it if you're getting a slightly less yield? So this is a precursor and usually tells us that a recession is right around the corner. And if you look historically on the chart, when the spreads thinned down, what occurred right after that? Well, we've typically had some significant pullbacks in the market if you go look historically. So it's just another one of those shots across the bow saying, hey, something is not right in the economy.
So the spread is closing because the government bond is no longer the gold standard in,
Correct.
in the
either,
bond?
Either the investors say that's not
riskier.
Right.
That's what's happening.
We're not either willing to buy corporate debt. So there's two ways to look at this. Either the government's is a riskier investment than it was, or corporations, we don't trust you, and so we're not going to buy it. We're just, people are not going to give. And if corporations can't get funding, then they can't grow, and then our economy can't grow. Both are bad scenarios.
All right, the corporate bond spread is at a historic low. Next item you sent the team, the price to sales ratio on the S&P 500 is at a historic all-time high. What does that tell us?
All right, so we're willing. How many times sales? So we talk about price to earnings ratio. Sometimes that's called a PE ratio. So how much do the companies earn? And there's a multiple. So the S&P 500 is estimated to earn around $285, $290 over the next 12 months if we collectively put all 500 companies as one. And historically, the multiple is around 17. We're trading around 22.5 times that number. So that's rich on the earnings side. This is another way to value the market. Price to sales ratio. And we've never gone up here past 3%. We briefly did this a few years ago and quickly corrected because that is historically high. So right now we're over 3.15% price to sales ratio, all-time highs. That has to correct as well back to the mean. And so typically we're going to say price to sales is usually just over 1 to 1.5% or 1.5 times. So again, another cautionary tale. How overvalued are stocks currently? Well, again, irrational exuberance, 1996, famous speech by Alan Greenspan. Well, the market ripped double-digit returns for 3 more consecutive years. So I'm not saying it has to stop here, but if you're walking into retirement, are you willing to bet your whole portfolio with that much risk? Make sure you understand the risk you're taking. That's the theme of today's show.
In the time we have left, we are going to go through a run of stories about Nebraska and the ag sector. Is it up? Is it down? We begin with an item you sent the team about farmland by state. Yeah, I always knew we were an ag state, but Nebraska is actually number 1 in farmland per acre.
Yeah, that surprised me too. And I sent that to the team. I knew it would be a top 5 or 10 for sure, but I didn't realize, just because I think of the sand hills, I don't think as much farmland, right? The topography changes in the western parts and the bluffs, but farmland per acre, we have more than any other state. That was 90%. Pretty interesting. Yeah, 90% of our land in Nebraska is considered farmland. So, hey, we are number 1. We've given a lot of great data here in the last couple of weeks. We rank really well here. So, however, though, in the ag sector, I know what you're going to hit me with next, right, is, well, some of those farmers may not be doing so well this year compared to other years.
Well, and the federal government says so as well. Feds say, this is from the Nebraska Examiner, Feds say Nebraska GDP shrunk more than 6% in early 2025, and it's because of the hit to the agriculture sector. Actually, Nebraska and Iowa, according to the federal government, 6.1% decrease in GDP. Now, a state official in the same story says, well, if you look at the quarter-over-quarter comparison, we're down 1.5%. Are we comparing apples and oranges here, or what? How do you see it?
That's exactly what it is. So 1.5% quarter drop. That if you annualize, if that rate continues, then that would be 6%.
Okay, that's how you get to 6.
That's how they're getting the 6%.
Okay.
And again, it's more sensationalization. There's a lot of folks in the media that are not fans of the current administration. We know that, so they're going to pigeonhole this or push the story in a negative light. The reality is, absolutely, our farmers, the prices they're getting for the commodities we're producing, corn is really not doing well, right? And when corn's selling for only a little over $3 a bushel, our farmers are not making a lot of cash, right? And so that is of great concern. However, since both those articles were printed, and we even had Don Bacon out there kind of talking now, Bacon is free to talk a little differently now that we know he's not running for Well,
Okay.
this seat anyway. We talk about he might be running for something else, but
Omaha World Herald interviewed him. Don Bacon concerned President Trump's tariffs now weighing on economy of Nebraska and nation. Yeah.
Deb Fisher, who was cited in one of those articles as well, whose family is ranchers, et cetera, has a little different take, a little bit more positive spin on it. I will tell you, since any of those were printed, though, and you sent them to me, they're going to be on the show, Trump was just on the air this week talking about soybeans in particular, which we have a lot of soybeans grown right here in Iowa and Nebraska as well, and negotiating deals as part of these trade deals. And he's told the farmers, hey, give me some time. And I think they will give them time, but you're absolutely correct. This would be a concern if we don't have a deal before we get to the fourth quarter, right? Harvesting comes around, and these guys got to know what their commodities are going to be sold for. Of course, that's why farmers, larger operations, have hedging operations in place. You can hedge these prices. So I started my career as hedging, right? So with commodities and options, et cetera. So to our farmers out there, listen, if you're not sure, depending on the size of your operation, you need help getting a hold of somebody to help you hedge, we can make referrals. We don't do the hedging for farmers, by the way, here, but we have contacts that do just that.
Well, a farmer is a businessman who I suppose is like you. You've often said, at least give me some stable ground rules.
Yeah, we need to know the runway. What's the rules of the game I'm playing in?
The parameters in which I'm operating.
And that's the scary thing is the farmers, do all the work, plant in the ground, and then they have to wait, the season 6-8 months later before they reap the benefits of their crop. And then what are the prices, which is why you hedge.
Well, I'll just quickly note, you sent me something from Freedom Press, Nebraska Cattle Surge, a new era, that on the cattle ranches, things are actually looking pretty good. There's been a lot of rain. The pastures are in good shape. So the herds are expanding.
Flipping the script the other way, cattle is very profitable now, and we're getting great prices for cows. And so many ranchers are expanding. We have several clients that run herds and all are expanding their herds right now, and that's the right thing to do because there is going to be there's a demand for good Nebraska grown red meat, right? And that's what we eat in my household. So I think this is fantastic. So again, the farmers, depending on what business you're in, ag or livestock, different picture right now.
We'll keep an eye on all this, but that'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. Tune in next week. We have a major announcement we're really excited about.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Neither Tom Osborne, Des Moines Adams, nor teammates are clients of Retire Smart and were compensated for this sponsorship endorsement as such term is defined under SEC Rule 206, subsection 4-1. For further information about this sponsorship and the compensation details, visit retiresmartnow.com and click on the Sponsorships tab. Companies on the 2022, 2023, 2024, and 2025 Inc. 5000 lists are ranked according to the percentage of revenue growth from 2019 to 2022, 2020 to 2023, 2021 to 2024, and 2022 to 2025, respectively. The full 2022, 2023, 2024, and 2025 Inc. 5000 lists were published in August of each respective year. Smart Wealth paid Inc. magazine a non-refundable processing fee each year to be considered for inclusion on the Inc. 5000 list.